I've been talking about the gap a lot on this channel, and I actually recently opened up a position in the company. And that's what I want to walk you guys through in this video. And so guys, as you smash that like button, let me run that intro. What's up guys, and welcome back to the channel. Now, before I even get into the breakdown, the first thing that I do want to mention with retail as a whole is that the thesis behind the gap is really that we're throwing good management at a business that does have a reputation for bad economics. So what does that remind you of? That's really a quote from Warren Buffett, where he said that when a manager with a reputation for brilliance tackles a business with a reputation for bad economics, the reputation of the business remains intact. So what I would say there is that, retail in general definitely has tough economics, and so you'd have to take this with a grain of salt. Now, I do believe that the Gap has certain competitive advantages. They do have reach and distribution. However, that could be a double-edged sword, especially if the brand goes out of style. So it's just something that you got to take into account. And when it comes to diversification of this particular opportunity, you'd want to make sure that your portfolio is very diversified, because I would classify this on the higher risk, higher return type area of the portfolio. So I wouldn't necessarily make it a core position. And the tracker itself tells you that it's a more riskier position, because you can see that in the tracker, this is the tracker that the Patreons get access to. You can see that this is the Gap, there's their ticker, that's their intrinsic value that I've calculated for them. They're trading at around 50% of their intrinsic value. But notice that I always say that price to intrinsic value, which is this right here, is the least important indicator. You always got to look at the qualitative, and these are the 5 boxes that I have, just like the 5 main boxes for qualitative analysis. It's not an exhaustive list. You know, there's a specific story to each company, but just something that I can look at each company and compare them against each other. The first thing I'd ask is, do they have debt? Well, the Gap doesn't necessarily have a lot of debt, so that's one thing going for them. However, they do have those operating lease liabilities. They can get renegotiated in tough economic times. However, it is an overhang, so it is they do have some operating leverage there. But okay, that is what it is. Are they inflation resistant? Absolutely not. And I made the point here that the discretionary retail spending is one of the first things to slow in a pinched consumer environment, and this is the primary reason for the share price decline right now, despite early evidence of a turnaround. And so in terms of being inflationary resistant, it is not that type of company, and so there is a huge risk here, especially if the consumer environment continues to get rougher. Do they have an economic moat? I would say medium, not high, not low. Fashion retail is very tough. It's a very tough business with relatively limited moats. I think scale and distribution does help. Also, just, there is name recognition, at least with the Old Navy brand, and I would say with the Banana Republic brand as well. Gap, I mean, people still shop at the Gap. It makes a lot of sense, but, I would be the first to admit that it's not as popular as it was maybe 20 years ago. So, in terms of an economic moat, I would say medium. With respect to the stock-based compensation being greater than 10% of the free cash flow, this is one way that management can erode some of your returns. So no, the stock-based compensation is not greater than 10% of free cash flow. The tech companies generally will have this being high. And then how is the intrinsic value realized? Well, the company's trading at 12.5 times next year's earnings, but next year's earnings are pretty muted, and so or pretty low. But what happens if the earnings go from 80 cents, which is what we're expecting for 2023, to $1.57, which is what I've modeled for 2025? Well, the PE would be cut in half, and so it'd be trading at 6.2 times earnings. And so that's where you can really realize through growth and revaluation. Earnings are going to grow, and you could expect that to revalue potentially even to 15 times earnings. So we'll see how that plays out. But as you can see, because there's an orange and a red in these 5 boxes, it means that it's not a truly exceptional business. But note that the truly exceptional businesses are typically always at the bottom of the tracker, as they rarely come up for sale. And so this is where that whole Warren Buffett, Charlie Munger thing comes into play, where if you have the opportunity to pay a fair or reasonable price for an exceptional business, always take it. And so, when a business comes for sale that has greens, like dark greens all the way across those 5 indicators, plus more things going for it, I would say that if it's trading at around 80%, 75% of its intrinsic value, I'd probably make a large position in it. But it rarely happens. Since I've been on YouTube, maybe I think 3 businesses in total that are green across the board have made it to under 75% of their intrinsic value, or even under 80% of their intrinsic value. So it's very difficult to find those. And so sometimes, I diversify the portfolio into, core positions, and then a position like this, which is more of like a higher risk position, but, a lower allocation overall of the portfolio. It's fine with me. And of course, that's not a recommendation for you guys to buy or sell or anything. Always talk to your investment advisor before you make any type of investment decision. But now let's go into the model that the people that have access to the tracker see. So here's the GAPS model. You can see that, a couple of years ago, it was a $2 per share business. Then, COVID happened, and they ran into their issues, and, they started losing money over the last 3 years. They're now expecting to return back to profitability with cost cuts and bringing the inventory back down. The question is, can they return back to being a $1.50 per share EPS business? Because, $1.50 per share with a 15 times multiple, that's a $22, $23 per share security that's trading under $10 right now. So, could this potentially be a double just on bringing the business not even back to where it was, but just somewhere close, or just somewhere higher than where it is right now? I think that there's a more likely than not chance that this business will get to the 120, 150 per share area. It might not even happen over the next 2 years. It might take 3 or 4 years to happen, but I think it's more likely than not that that will happen, especially if they focus on continuing to keep costs down and getting rid of non-performing stores. The other thing is further investment into the omni-channel, so digital. Also doing similar to what Foot Locker is doing, where they're increasing their footprint in areas that are off mall. And I know Gap and Old Navy are really good at that already. They do that a lot. And so the question is, can they do that a little bit more? Can they geographically expand as well? And one of the comments that I made earlier is that, Old Navy is a brand that's really primarily only in the US and a little bit in Canada, but you have a new CEO coming in who focused on international expansion for Walmart. So that's something that Old Navy can do as well, because you have blue ocean's opportunity if you can figure it out. And so before we move on, just a quick plug: if you want access to the tracker, you can get access to it at that lower tier of the Patreon. And if you want to join us for an epic live presentation, you can join us at that higher tier. And guys, like I always say, there's 100% money back guarantee. If you do not feel as though it's a value to you, let me know and I'll refund your money in that first month. Now, the way that I entered into this particular opportunities, I actually used an option strategy just to sort of like limit my risk. What I want to do with you guys in this video is I actually want to take you through 3 different options opportunities. I think 3, maybe 4 different options opportunities, and just let you know how I think about them. But also, just FYI guys, the free options calculator that I'm going to use to analyze these opportunities is available in the description below. So you don't have to pay anything for that to grab it. Just grab it and use it to analyze these particular opportunities. So first, let's look at both the in the money cash secured puts and the out of the money cash secured puts. So, as of the recording of this video, the $10 cash secured put was in the money because the shares are trading just under $10 per share, and the $7 cash secured put was out of the money because the share price was much higher than that $7. Now, just looking at the $10 cash secured put, you can see that the premium is $2.10. Also, just FYI, the way that I build this model is I put in a money market rate, because what ends up happening is when you purchase or sell a cash secured put, really what you're doing is you're setting money aside. Well, in this environment and in every environment, the money that you set aside is generating income at the money market rate. And so you put in a percentage amount here, which is something that earns you interest, which ultimately goes into or should be factored into your return. Note that the cash rates can change. So I used a lower figure than what you can get right now. I think there's people who are getting 5% right now, but I just put it at 4% because the rates can go lower. I don't think they will, but just to be conservative a little bit. Now, there's only 2 things that could happen if you sell a cash secured put. The first one is if you are not assigned on the cash secured put and thus you don't own the shares. And the second is if you are assigned on the cash secured puts and now you do own the shares, if I only could spell the word own properly. And so let's look at the first one. So what happens if you sell the cash secured put and the shares at the exercise date, which is Jan 17, 2025, which is just over a year, so a year and a quarter, if they're not under $10 per share, then you are not exercised, which means you keep the premium, which is the $2.10, plus the cash interest earned. So you actually made $2.52, which reflects an annualized yield of 24%. Now, if you do get exercised, what ends up happening is you ended up getting a net purchase price of $7.50, which is effectively the $10 less the $2.10 less the 42 cents of cash interest earned. And so, with respect to making it a percentage of the valuation, the 748 as a percentage of the valuation is only 40%. And if the company's run rating at $1.57 per share, then you have an annual equity yield of 21%. So no matter what happens in this binary, assuming that the company is able to recover, which I believe that is more likely than not able to recover its earnings back into that 120 to 150 area for the next couple of years, I think this potential opportunity looks very good. Now let's look at the $7 cash secured put opportunity. So with the $7 cash secured put opportunity, you can see that the premium is 85 cents. So your potential annualized return when you're not exercised on the security is 14%. And so that's not bad. And the reason why that's not bad is when you look at it in conjunction with the situation that occurs or potentially occurs if you are exercised on the shares and you end up owning them, your net purchase price is $5.82. And recall, the current share price is $9.95. So you're trading well below the current share price. And so you have a huge margin of safety here. Also, you're trading well below the valuation. You're trading at 30% of the intrinsic value, or at least what I believe the intrinsic value is. Now, here's a more important thing. What happens if the company doesn't realize the $1.57? If they realize the $1.57, you're making 27%. But $5.82, how much does the company have to earn to generate a 15% equity yield for you? And the amount is just the 582 times 15%, which is 87 cents. Now, why is that important? Recall, guys, that the company said that they're going to earn 80 cents in 2023. Well, if they just continue to move along on that trajectory, can they earn 90 cents in 2025? I think absolutely they can, especially if they keep turning this thing around the way that they're doing it. And so what this lower purchase price does for you is it gives you a higher margin of safety, and you're likely to generate, if things get worse in the current environment and you do get exercised at that $7 price, then you have such a low net purchase price that it doesn't take a lot for the company to generate a large return for you. I would suspect that the $7 cash secured put is one that probably won't go in the money unless we have a material consumer slowdown, which there is evidence that could potentially be the case in the next year or so, especially if rates stay higher for longer. So with the two cash secured puts, you have one where it's like, I can generate a really good return and I have good safety. And with the other one, you can generate an acceptable rate of return, but have an exceptional net purchase price. So it's really up to you how you want to think about it. Do you want more safety or do you want more yield? Now with the covered calls, you can see that it's similar. The yield is around or the premium is around $2.10 for the $10 covered call. And so throwing that in, you can see that I just took the midpoint, so that's where I get the 210. Now the other thing that you have to pay attention to is this company pays dividends. With covered calls, you actually own the security, and then you sell the rights for somebody to take it away from you at the money. That's really what it is. So you're buying it at $9.95 and somebody takes it away from you at $10 if by this date it's trading above that amount. So if the share price doubles, you only get $2. You don't get the full double. So just keep that in mind if you're thinking about investing in this type of opportunity. Now the good thing is that the company is expected to pay dividends. I don't see a reason why the company would stop paying those dividends. However, if the consumer stays slower for longer, I would expect them to cut the dividend and use that extra cash to pay down the debt, or just right size the company. So I don't actually know what's going to happen. I actually put in the dividend into my calculation as I calculate the return, but by all means, I would recommend in this particular scenario to be comfortable in a scenario where they don't have dividends. And so what does that really mean? Well, notice how if you're owning it for a year and a quarter, you're probably going to get around 80 cents worth of dividends. And so that increases your premium from 210 to, a cash inflow of 290 plus that 5 cents of a capital gain that you get, the difference between the 9.95 and the 10. So if you are assigned on the covered call and you lose the shares, you've made $3 per share on that, or effectively a 28% return. So that's not bad. Obviously, if it goes to $20, you lose out on that double. But I think 28% is not bad, considering that your net purchase price is substantially lower than the current share price, right? So that's the whole point of this. This is giving you safety. It's bringing down your net purchase price. Now, what happens if you're not assigned on it? Well, your cost basis is actually $7 per share, and I put the wrong valuation in here. It's really $18 per share. So, call it 7 divided by 18. I think it was 1863. You're talking a 37% cost basis as a percentage of the intrinsic value. Now, if the EPS continues to run at $1.57, well, $1.57 divided by the 7, you get 22.3%. So I don't mind this one really. I like the potential yield if you lose the shares, and I do think that you would end up losing the shares more likely than not. So making 30% on this is not bad annualized, and if you keep the shares, well, your cost basis is $7, which I think is incredible because it's so much under the current share price. Also $7 for a company that on average will probably generate $1 per share. That is a pretty decent yield as far as I'm concerned. And so I want to know from you guys, what do you guys think about the potential opportunities that are available to you? Or do any of these stand out to you, or are you just staying away from retail? Now, if you've missed the other 2 videos that I did do on the gap, you can actually get to them right here.